I'm Steve Smith, Sales Director of Roma Finance. We're going to be talking about developments at the moment. So if we just go through the developments as people come in, they can just catch up with how I do it. So here at Roma, we basically look at the borrower first rather than the properties. So specifically on developments, we look at sort of because it could just be some land with planning. So it might have some property on it, might have a barn, it might have a commercial property. We do commercial as well as residential developments. So we look at what the customer's motivation is, if they're an actual property developer by trade, or they're a plumber, or they're a builder, or they've got absolutely no experience and background in it whatsoever, and it's their pension plan. That's absolutely fine as long as they have a builder who knows what they're doing, and ideally some people around them that know what they're doing. So we look at sort of asking the right questions to you, and obviously what you need to do from the borrower itself. So why are they in this space? Motivation, background, experience. The big one is costs and timescales being realistic, and the even bigger one is how they plan to exit. Currently, in what we've got at the moment in the economic space, we've obviously got some exits that are proving more tricky than others. So we probably will go into a period where we do extensions, we look after those clients because we want repeat business, and that's from yourselves and the actual borrowers themselves. So looking at costs and timescales, are they realistic? Because we've seen less so now on the costs, but certainly during Brexit, certainly during COVID, we saw costs of materials really get climb and climb and climb. They seem to have plateaued out, come down a little bit, and timescales, it just depends. It depends on the exit, and that's why the exit is so important. It's getting harder for the commercial sector to sell those exits if they're priced at the top end. But we're still seeing a lot of sales in the residential section. So if they're building sort of residential properties, we're seeing those exits pretty much on time. We're seeing a little bit of a stretch on timescales on the commercial side. But at Roma, we do underwrite the person and not the property. So don't worry about what state the property is in. We very much want to know if the borrower is capable of doing that development scheme themselves. A little bit of a fact for you, and we love a fact here at Roma. According to Mintel, development loans are estimated to account for 60% of the aggregated bridge loan value. So if we look at developments themselves, they're getting huge, and we do a lot of developments. We're probably our heavy refurb development probably accounts for at least a third of all of our loans currently, and I don't see that changing. We see a lot of refurbs in what we do, a lot of sort of conversions, and a lot of ground up developments. The fact that we do them in England, Scotland, Wales, and the fact that we do sort of commercial ground ups as well, slightly different for some of our competitors because that's an actual market that we're keen to get into. And we do quite a lot of developments in Scotland itself because a lot of our competitors don't. We love to lend. Probably one of the biggest things at the moment in the marketplace is that we have our own funding, but we also have 9 funding lines. And those funding lines are large and from British banks and building societies, not from overseas, which is an important factor, and not from pension pots that are being messed about with currently in the market. So we have funding lines from established UK banks and building societies, and that is a really important thing to note when dealing with funders. In the bridging market themselves, there's probably 200 plus bridging lenders out there. Some of those lenders will have one funding line, and that may be impacted because of the economic climate at the moment. So for you as a broker, know your funder really, and it's interesting. It's not all about just rate, it's about service and the ability to complete, and we certainly have, I would like to say, all those three covered. So our products, we obviously use a lot of developments, but how we class developments, we have medium and heavy development. So a heavy development is basically where the property is 200,000 and you need more than 200,000 to actually develop it. So you're really ripping it apart. A medium is where it's 50% to 100% of the value of the property in work. So if it's a 200 grand house or building and you need 150 to develop it, that would be a medium. If you needed 400 to develop it, it would be a heavy. We look at ground up developments. So ground up for us is basically land with planning, or there might be a shack or barn on there that needs to be taken down first. We also look at part built, and I think this will be getting more and more common, your part built and developer exit products, because part built, maybe it's part built with their own money and they've run out, or part built with another funder and that funder's either run out or decided they don't want to continue because of certain delays or whatever. The part built is slightly different to developer exit. A developer exit is when it's wind and watertight. So it's just the internal fundings that we might have to give a little funding to and then pay off a current funder. A part built could be they're part way through it. And we'll look at it. And if it's still within that 65% loan to GDV, we can look at paying off either their current lender or not if they've done it with their own funds and giving them the funds to actually build it through. So I think really we do a lot of these, but a lot of the market, the way it's going, I think part built and developer exit will be very common in the next sort of 6 to 9 months. A couple of case studies for you because I think it's really important that you actually understand what we do. When I said we don't care what kind of property it is, we really don't. This was the first passive house. By passive house, we need eco multi-property ground up. So it's basically completely category A when you look at sort of an EPC rating. It has all kinds of absolutely eco wonderful things to it. And it was a very difficult one to fund because a valuer couldn't actually give us a valuation because they'd never seen one before. So it was in Lanarkshire in Scotland, and it was basically the first development in Scotland of sustainable passive houses. And it was a big site, it was a big amount of money. When the case came to Roma, my cousin had already completed the sale of one of its first house for 610, and then the second property was then sold for 620. And we lent them just over 500,000 to redeem the existing development loan they had with another funder who didn't want to continue because they were nervous about the passive house element. When in actual fact, he sold all the houses for more than they were actually originally worth from the valuer because as we now are now fully aware, eco is has got now a badge of honor to it. People want to live in these kinds of houses, they want to save money. We've seen the energy crisis, we're seeing the energy crisis continue. If you've got an eco house and you can actually put money back to the grid, or you can actually just be sustainable yourself, it not only gives you money off, but it also protects you from the future. And these houses literally had everything. It's not just solar panels and a water bus. It is absolutely triple glazing. It is water pump heaters. There's all kinds of things in there that made them really an EPC A rating. And we will see more and more of these types of properties as people develop, as architects look at the eco environment for the environment reasons and for price. Price of energy is going up. We know that fossil fuels won't continue forever. We're not really building nuclear power stations in this country, so we will be looking at wind and air power. And I think when you look at the prices of energy, having an eco house does put a little bit of a premium on it for people who will rent or buy them. So we'll see more and more of these types. And this was a really interesting one because, as I said, we had to take a bit of a flyer. We had to look at what had been done in other countries, specifically Sweden and Norway, who do a lot of these passive houses, because we'd never done it in Scotland. And the valuer literally came and said he could not give us comparisons. So we had to sort of look at it and go with what the actual architect designed and did, and what the actual builder wanted to do. And in the end, they actually sold them for more than that value that we actually came to. So it was a real win-win all over the place. And then we're very happy with what we did. And we're looking at future products with them as well, future projects with them as well. This one is a more sort of simplistic design, if you like. It was done in the pandemic, so it was done during COVID. We didn't stop lending during COVID. We absolutely supported our clients through COVID and actually did full-on developments and work throughout that period. This was an existing property with planning consent for a new build detached house in the back garden. You can really see, I know it's difficult to see the pictures, but if you look at the front of the house on the left-hand side, that's what it looked like at the start. And the back garden, it was a large back garden, and they had planning for a new build. You look at then the middle bit, which was the planning. You can see, you can't really see the map, but it was a very large garden. You can see it's larger than the others around it, and because of that fact, they could build that property at the bottom of the garden that you can see on the right hand side, and they did it to a really good spec. And how we did it, we originally gave them 300 grand for the build costs. They already owned the land itself. They'd got planning themselves. They'd paid for that. And once it was wind and watertight, we refinanced onto a less expensive bridging loan with an additional 125 grand to finish it off. So 425 in total, and the new property was actually sold for 700,000. We actually got the security of the first charge of the new build and a second charge of the main house, which you can see in that first picture. So we do look at structuring deals. We look at trying to help out as much as we can, giving as much money as we can. If you want to give a second charge on your main house or a first charge on a buy to let, it all helps. You don't need the deposit funds. Then we can actually do 100% funding if we've got the additional security. This was a really good one. It was an existing property that we knew. The person was actually one of our borrowers that we actually knew before, and they've already gone on to do their second and now third development with us. And that what they do is small. I would say small. It was a really big house, but it was a one property development. It wasn't sort of six or seven. But this was a really interesting one where we're seeing this a lot in society, where if they've got a very large amount of land, specifically in the back garden, as long as you get access rights sorted with planning, it's a really good way of building and using your own land to provide a great deal of wealth. This property was sold for £700,000, and he'd already got the land as a back garden. His kids had grown up, they didn't use it for football anymore. He had access at the bottom by the trees there, and basically it was a really good way of him securing his future. So really interesting one. Think we need to look at pitfalls. I think we need to look at sort of what we actually look for in a full-on ground-up development, because a ground-up development, it's a big investment. It's a big investment of time. It can take, we'll allow up to 2 years. It's obviously more expensive the longer you go with bridging. But we can allow. But you have to look really, have you got the pricing right for the contractor? Um, we've seen things get out of control. We've seen things, particularly during the pandemic, where it took a much longer time to get them, which then put problems on the builders. They would go off on other jobs then to get them back, and you're still paying that interest. So having a really good approved pricing from a contract and sticking to it is good, and having a contingency in place is absolutely key right now at this moment in time. A firm exit strategy is always useful for any bridge, be it a standard bridge or development. We need to know if you're selling that property and have you got a time limit in place to do that, and is that viable? Or if you're going to get onto what could be even more a viable marketplace, have you got that exit in place with a mortgage or with a term loan? We've seen a lot of those pulled at the moment. We're still offering our own term loans on the back of our developments and bridging products, but not everybody is. So have they got a firm strategy in place? And in this current climate, have they got a second strategy in place just in case that first one doesn't come off? Have you got a proper time frame? It's really important that, as I said, development bridging gets more expensive the longer it takes. If you're going to have a problem with the contractor or timescales, it becomes more expensive, full stop, and that all eats into their profit. The best way of using a bridge, and I say this as a bridging sales director, is to do it as quickly as possible. That way, your costs are minimal and the profit is maximum. You've got to trust your contract to deliver on time and on budget. We've seen already with some of our borrowers, and the main time when a borrower gets into difficulty, it's because the contractor has let them down, or they couldn't do it in a certain timescale. So the contractor, for their own reasons and viable ones, have gone elsewhere for business. And then suddenly you're in a no man's land without the contractor you wanted to deliver on time and on budget. So then you have to go to a different person, which could take longer, could be different pricings. So all these things, just really get yourself in a position where you've got a contingency in place, an exit strategy in place. Is the time frame viable? And basically, do you trust and have you got an approved pricing from your contractor? You get all those things right, and we're seeing this far more often than not, people getting out on time or before time at profits. And that's really what we want to do. We want to lend people money so that they can make money, because that way you get your commission, we make our profit, they make their profit, and they come back round to both of us for their second and third and fourth development product. So what is our development criteria? Well, it's very hard to put up. We are an unregulated lender that lends in England, Wales, and Scotland, and we are flexible and have tailored terms and commissions. So it depends who you are, what you want, who your client is, what they want. Our rates are generally, as you can see, for a residential development facility, 0.95%. Up to 65% LTGD gross. That works backwards. So if you're looking at a GDV of the whole development is going to be £2 million, we'll lend you 65% of that. Commercial development funding, we do up to 60%, and it's slightly more expensive for the obvious reasons. And the developer exit, when it's wind and watertight, it's a much easier. We'll do up to 75% and 0.75. On the developer exit, there is no exit fee either. With the development ground up developments on commercial and residential, there's a monthly exit fee. So it is 1 month, whatever the rate is. But from what we do residential and commercial developments from scratch. We can do up to 12 new build dwellings in any one project. And we have a top out in London and within the M25 corridor, it's £3 million as our maximum development. For the rest of the country, it's £2 million as our maximum. Modern methods of construction are considered. We're seeing that a lot. We're seeing sort of, a lot of different types of construction. We look at things like timber framed as well, flat roofs. None of this really worries us at all. Part built projects are definitely considered, and we're seeing more and more of these as potential problems have occurred with timeframes, lenders pulling out, or clients deciding they've got too many things on one go and parking some projects until later. We look at borrowers with finance with the lenders as well. So if we need to pay off a lender and then continue, we can do that. And the developer exit, which we're starting to see pick up, um, and we've got two types of developer exit. The developer exit, which is the true developer exit, which is your wind and watertight, but we also look at part built developer exit as well, where it could just be they've run out of time or run out of their own money, or a lender has pulled out of them and we can take over, as long as it's within that loan to GDV cost price range of 65%. What we require? Well, in addition to our standard requirements, I mean, basically, we only need a signed AIP, a completed application form. For the developments, we obviously need planning permission to make sure that's in place, and a breakdown of costs and a schedule of those costs, ideally. We then look at, we will send out, we can either take bank statements or send out open banking, or we can take ID from you, or we can do a Credas app, which then they can do the ID and the photos with passport and driving license. So there are many things we can do. We can be very, very easy to deal with. There are BDMs up and down the country. In your areas, you will have a BDM. If you have a pop on our website, it'll tell you which BDM is yours, depending on where you are in the country. Give that BDM a call or an email, and they'll come straight out to see you, have a coffee, chat through either developments directly, or just talk you through the process. You can have video calls with them, meet with them, or just do it over the phone, depending on entirely your call. We're quite happy to come out and see you. We're quite happy to do video calls to get to the real crux. And I think it's important, especially in this economic climate, it's important to communicate. Let's be really honest about what the borrower needs and wants. Let's be really honest back to you about whether we can do that. And if we can, let's get it done. There's a lot of we can see in these environments where people are unwilling to tell us the truth and the facts. But if you're saying this is your first time, but there's a valuation that's come from Together or Mint Bridging, we can see that you've gone somewhere else. Just be honest and tell us why. Tell us why they didn't want to do it. That doesn't mean to say we're not going to do it. And I think it's really important to be open up front, and we'll be open up front back to you. And I think that's the best way in uncomfortable economic climate. That is the best way to do business. Just be really open and honest. And that is really it for developments. It's a really simple way of doing developments. We look at anything from your sort of 100,000 first apartment to, as you say, 3 million in London, 2 million outside London. And any questions you've got, please let us know. If you don't have them now, please jot down our phone number and our enquiries at romafinance.co.uk email address. That will come through to the BDMs as a whole and my sales support staff. They will come back to you. If you do want a meeting, if you do want to chat with one of the BDMs, please just email at enquiries at romafinance.co.uk, or pick up the phone and give them a call, and they will be able to do that for you. Equally, if you need to contact myself, I'm easy to get hold of, steve.smith@romafinance.co.uk. And if you want to speak about a complex deal or a large deal or whatever with myself first, or find out a little bit more about Roma Finance and what we offer, by all means come through to me. But there are many ways of coming to us, email or phone, and I'm quite happy to come out and see you with a BDM and introduce them as well. So just if you've got any development deals, pick up the phone, drop us an email, and let's get started on them. Let's see if we can do something with them. And that is pretty much all from me. If you have any questions that are burning questions, please let me know right now. Otherwise, drop me an email and I'll sort it out. You're very welcome, James, and very welcome, Michael. No problem at all. No, that's absolutely fine. Let's leave it there. As I say, you know where we are. If you need to come and get in contact with us, please do. Quite happy to call you back, have a chat about a specific deal, or have a chat about our criteria in more depth. No problem at all. Thank you very much.